ignore the sell-offs and just look at a silly price chart of gold or silver. Just for example, back in, remember, silver was capped off at $35 October last year and March of this year, and was in a 1-year sideways range. And when it came back up through 34, we said, watch out, this time it's going to blow, but it's going to get more vertical. It's been a 50% increase in price since then. And 8 weeks prior to last week now, 8 weeks of higher highs, higher lows, 8 weeks in a row. I mean, that's highly unusual. Can't it have a break where it takes out a prior week's low? Is that really a disaster? Now, gold, which is interesting, last week, when silver took out the prior week's low, it refused to take out its prior week's low, so it had 9 weeks of higher lows. Today, finally took out a prior week's low. And it's the end of the world? Let it breathe, okay? It's an opportunity to buy if you're not already in. I don't see protracted congestion, which is what we had April, May, June, July. In 5 months, gold went dead sideways in about $150, $200 range. They kept selling, couldn't get it down. It kept coming back up. Finally, it took off. No, you're not going to have any more protracted congestion zones. You can have sharp sell-offs from time to time, and maybe somewhere in the middle of the next 6 months, you're going to have a pullback that actually involves a month, not just a week, okay? But right now, we're not at that point. The action last week, to a large extent, put us in a position where, in our weekend report, we suggested that was probably mostly it, okay? Now, the only problem was gold hadn't taken out a prior week's low, and so we finally did. That means we got under 4,000. Okay, it's back above there now. I think the cleansing we just had is probably about exhausted, and that when you flip back up, it's not going to take you 3 months to get back to the high. It might take you a week or so. Okay? And I think when that happens, people say, well, golly gee, they did it to me again. They fooled me. We're in an accelerated mode, but there's certain other huge technical triggers that actually imply fundamental triggers that we included in our weekend report. And I don't know if you can show those.
Keep talking and I'll look for that.
Okay. On page 1, we had a technical situation. Yeah, here we go. Spread chart. There you go. Now, what this chart shows, if you can get even closer to it, it'd be good. If not, what it shows is gold going back to about 2013, plotted in its percent relationship to the S&P 500. Okay. The biggest bull market out there right now. U.S. market is the bubble. No other market in the world matches what we've done. Okay. Since 2009 low. But anyway, gold is in decline since its 2011 peak in price, but also relative to the S&P. It kept coming down, and here we start in 2013. And in 2015, late in 2015, gold made its price low under, 1,050. Well, that's when the spread dropped down to about 50%, that first sharp low you see there. And then you rallied up, okay, and you got distributed into, back down again, lost more ground versus the S&P, got down around 40% of the price of the S&P, then shot up again to that plus 60 level, got bagged again, back down to 40%, and then based for a couple years. And we broke out of that base early this year and ran up again where? To the green line that was developing as a structure. And sure enough, in April, when gold paused, as you noted, when we went sideways for multiple months, the spread backed off a bit, meaning gold lost some ground versus the S&P. And then when the recent reassertion of price back out above that 3,500 price level also drove the spread back up. Now, this spread reading you're looking at there was as of Friday, and it's probably backed off a little bit as of today. But at the end of this month is when we plot that final reading. Now, if you're at 60% or higher, and right now we were about 61 as of Friday, and which gold divided into the S&P, 61% of the price. You're at one of the highest levels on gold versus the S&P going back 10 plus years. Meaning, in reality, gold is doing better than the S&P has for the last decade, but nobody notices. But if you close credibly over that green line, which is now 1, 2, 3, 4-point trend structure, that is a massive relative performance breakout by gold versus S&P. Given the depth and the width of this base, and this is price versus price, so it's effectively a price chart. This has massive upside implications in terms of a shift in the money flows that go into gold and go out of the stock market. We're already seeing that. Gold's up a lot more than S&P over the last year, last 3 years even. So there's already been some money flow. But the average guy ain't in this market yet. And when this thing breaks out, we bet a couple things. One, gold's going to vastly outperform S&P going forward, probably for several years. it's going to be quite dynamic when it first comes out of here. It'll be like a whoosh effect. But you'll also start to get, probably a few months after this breakout, you'll start to get the headline type things that somewhat explain what is already happening. And we suspect those headline type things might be coming from the financial sector, where few people are looking. They're all looking at NVIDIA, okay? But anyway, forgetting the fundamentals, this tech to us, one, gold has been beating the S&P basically for the last 10 years, because it's the highest level in that period. And two, it's breaking out, meaning this relative valuation says it's only just begun.
You know, sometimes when people look at a chart, they panic. They see one red candle and they think the world's ending. But if you step back for a second and take in the big picture, you realize how absurd that reaction really is. Let's just take a simple example. Gold and silver over the past year. Remember how silver was capped at around $35 back in October last year? It touched that same level again in March this year. Everyone said, see, that's it. Resistance is ironclad. But what happened when silver came back up through $34? We said, watch out, this time it's going to blow. And sure enough, it did. It's been nearly a 50% increase since then. Now here's what's remarkable. For 8 weeks in a row before last week's small pullback, silver posted higher highs and higher lows. 8 consecutive weekly gains. That's not normal. That's a rocket. So when you finally get a week that dips a little, takes out the previous week's low, is that a disaster? That's just the market taking a breath. Gold, meanwhile, refused to even flinch for 9 straight weeks. It had higher lows every single week, 9 in a row. That's one of the longest stretches I've seen in years. Finally, last week, gold slipped just enough to take out a prior week's low. And what happened? Everyone screamed, "The top is in! The bull market's over!" But folks, come on, let it breathe. A healthy market needs to exhale before it can sprint again. What we're witnessing here isn't the start of a collapse. It's a cleansing move, a short-term washout that clears weak hands. The same thing happened in 2019, in 2020, and even in 2011 before the real fireworks. These little dips are not endings. They're pauses in a much larger ascent. If you study price behavior over decades, you'll notice something. Great bull markets don't die because of exhaustion. They die from complacency. And we're not even close to complacency yet. We're still in disbelief. Every dip, people think it's the end. Every pullback, they think it's manipulation or some dark conspiracy. But that's just how secular bull markets behave. Full of doubt, full of fear, until suddenly everyone's talking about it. Let's put it in context. Last year, from April through August, gold spent 5 months going absolutely nowhere, dead sideways, between roughly $1,950 and $2,100. That's what I call a congestion zone. It's where markets store up energy. It's like a coiled spring. You can push down on it for a while, but eventually it's going to pop. When gold finally broke out of that range, it didn't crawl, it launched. Now, people are asking me if we're due for another long, sleepy sideways pattern like that. My answer? Not this time. We might get some sharp sell-offs, quick 1 or 2 week dips to shake the tree, but the days of months-long congestion are behind us. We're in an accelerated phase. Maybe somewhere in the next 6 months, we'll see a more meaningful pullback that lasts a few weeks. But right now, the structure says the big move is still ahead. What's happening technically is fascinating, but what's happening underneath those charts is even more powerful. Because the technicals are now aligning with the fundamentals in a way we haven't seen in decades. Take the spread between gold and the S&P 500, for example. Most people never even look at it. They compare gold to the dollar or gold to inflation. But when you plot gold's price relative to the S&P, you get a very different story, a quiet revolution that's been building for over 10 years. Go back to 2013. Gold had already peaked in 2011 at around $1,900, and by late 2015, it was down under $1,050. Meanwhile, the S&P was on a tear thanks to QE, low rates, and a tidal wave of liquidity. The gold S&P ratio collapsed. It dropped to around 50% of the S&P's price by the end of 2015. That was the first major low on the chart. Then we got a rally, a pullback, another rally. The ratio oscillated for years, bottoming around 40% and topping near 60%. But this year, 2024, something new happened. Gold didn't just rise in dollars, it rose relative to equities. For the first time in over a decade, gold began outperforming the S&P 500 in sustained fashion. That's a monumental shift.
How likely, what's the probability that when you see a structure like this, that it does break through ultimately?
Yeah, now that's a point that we've noticed in especially our momentum work, is that when you build a structure that smacks you in the face with its clarity, like a spread structure or a momentum structure, not so much price. Price is often illusory because that's what everybody sees. And when everybody sees something, sometimes it's not right. Okay. But on a spread, which very few, I've not seen this in any financial publication, okay, or on CNBC or Fox Business. We've been watching it for a while. And when we set that structure in April and then backed off, that in effect told us, boy, do you have a real clear structure. You don't build something like this to wave goodbye to it. You build something like this as a starting gate to engage something new. And that's what we've done. And sure enough, we're out above there. And if we don't get out above there on this month's close, I bet we'll be out above there next month. You don't build this kind of thing and fail at it again. Too many hits. You're going. Okay.
Okay. So based on your experience over the decades, when you see a structure like this, it is inevitable. It may not be right now, but it's inevitable. Okay.
Yeah, and it will be soon because this thing is ripe as a beast.
Okay.
And we know the dynamics out there are quite strong now. So this spread, when it breaks out, though, it does say one thing that most people aren't acknowledging. It's just beginning.
What are investors missing right now, and what do you expect for the miners over the next 3 to 6 plus months?
Well, I expect them to go higher with gold, and I think they'll probably be a better performer over the next year or two than gold will be in terms of percent gain. But just look at GDX, for example. I mean, go back to 2011, it had a high in the 60s, okay? And then it dropped down, and where was it about 5-6 months ago? No, actually back about in June, okay? It was well below the old 2011 high. Heck, gold was way out above it already. And it was trading in the 40s, GDX. You went from 40 something to 85 a week or so ago. And you got a slam dunk $10, $15 pullback. Still way above the peak of 2011. You had a thin air pullback. Didn't break anything. It just says, golly, I doubled plus in a matter of handful of months. And I can't have a sharp pullback? Does that change the world? What do you think it's going to do? Go up every single month, every week? No, it's going to have pullbacks. And because you were in thin air, well above the 2011 high, which was like, we didn't even get to it this week when we pulled back into the high 60s. That's down to lower 60s. It's allowed to do that. It doesn't change reality. After all, it doubled plus in a handful of months. Can't it have a bad week? Okay. If you can't take that, you don't belong in these markets. Okay. You won't be able to catch the big move. We've had, silver dropped hard 1 week last week, okay, and some follow through this week. So prices only dropped for 1 week. But when we run weekly momentum, which is also in this report, you made a high on weekly momentum 5 weeks ago. So momentum has been correcting, pulling back. What I mean by that is that when you measure the price of silver versus, for example, a 3-week moving average. So you have the rising price and the 3-week average is rising underneath it. When you slow the pace of the advance, even though it's still strong, at a lesser pace than the rise in the 3-week average, then you're going to get a momentum decline. Last week was week 5 down on momentum, and you got into what we call an oversold situation with only that one bad week, creating an oversold situation. Whenever we've seen that occur over the last year, there were like 3 or 4 instances of where similar action occurred.
Now let's take a step back and talk about what all this really means, because it's not just about gold prices or chart patterns. It's about a tectonic shift in how capital is valued, how risk is perceived, and how people define safety. For years, Wall Street sold the idea that equities were the ultimate growth vehicle. Buy the dip, they said. Stocks always go up. And for the last decade, they were right. The S&P rose 6-fold from the 2009 lows. Tech stocks became the new religion. People stopped even thinking about gold. Why own something that doesn't yield when you can own something that doubles every 2 years? But that's how every bubble feels before it pops. What we're seeing now is the slow realization that the golden era of cheap money and infinite liquidity is over. The Fed can't keep rates high without bankrupting the Treasury, but it also can't cut without igniting inflation. It's trapped. And when the referee can't make the next move, the market starts to choose its own winner. And that winner is gold. The relative breakout of gold versus the S&P 500 is one of the biggest technical events of the decade. You could even call it the moment the tide turned. Because when gold starts outperforming stocks, that's not a side story. That's the story. And it's not just price action. The fundamentals line up perfectly with it. The debt is exploding. Fiscal sanity is gone. Every time the government adds another trillion, it costs more to service it. We're now spending more on interest payments than on defense, healthcare, or education. That's not sustainable. The only way out is devaluation, and markets know it. You can already see the footprints of the insiders. Sovereign wealth funds are buying gold. Central banks are stacking gold. Even the banks that used to ridicule gold are quietly allocating to it. Morgan Stanley, Bank of America, and JP Morgan have all started calling gold a core holding. That's not something you heard 5 years ago. Meanwhile, the S&P 500 is quietly rolling over. Underneath the shiny surface of Nvidia and a handful of mega-cap stocks, the breadth is terrible. The average stock is flat or down. The illusion of prosperity is being propped up by the last few darlings of the bubble. That's why when I look at that gold/S&P spread chart, I don't just see lines. I see the psychology of a market turning on itself. It's the smart money moving first. And here's what's fascinating. The crowd hasn't noticed yet. The average investor still thinks gold is boring. They're still chasing AI names and SPAC leftovers. That's exactly what makes this phase so powerful. When the crowd finally catches on, when the headlines start saying gold outperforms stocks, it'll already be up another 20 to 30%. And then you'll get the emotional rush, the FOMO, the inflows. That's when the whoosh effect hits. But let's not forget, the shift isn't just technical or psychological. It's deeply fundamental. The world is de-dollarizing. Central banks are trading U.S. treasuries for bullion. Countries like China are using gold to settle international trade through the Shanghai Gold Exchange. Russia's ruble is being loosely pegged to commodities. The BRICS bloc is experimenting with cross-border settlement systems that bypass the dollar entirely. In that environment, gold isn't just a hedge, it's a weapon. It's a neutral reserve asset that no one can sanction, no one can print, and no one can fake. That's why gold's rise is so much bigger than just a price story. It's the physical manifestation of a shift in global power. And now the math supports it too. Even if gold just returns to its long-term mean relative to global money supply, you're talking about prices north of $6,000 to $7,000 an ounce. And if the monetary reset scenario plays out, the kind where debt gets restructured and currencies get partially recollateralized, you could be looking at $10,000 gold within a few years. Now, some people say that sounds crazy, but so did $4,000 gold 5 years ago. You want another metric? Look at silver. Silver has always been the wild younger brother of gold. More volatile, more emotional, but often more telling. Silver's 50% run this year isn't a fluke. It's a sign that monetary demand is returning. When silver moves from industrial pricing to monetary pricing, the moves get violent. Every great monetary reset in modern history, 1918, 1933, 1971, 1980, 2011, has seen silver outperform gold by 2 to 1 or 3 to 1 in percentage terms. We're seeing that pattern form again. Now, as for the short-term noise, the little dips and corrections, don't be distracted. Markets breathe. They need to reset momentum before pushing higher. The difference between traders and investors is that traders panic when that happens. Investors smile. Gold taking out a weekly low isn't the end. It's a gift. Every dip in a secular bull market is an opportunity, not a warning. So what's the takeaway for viewers watching this right now? Stop fixating on the daily moves. Stop letting emotion dictate your view. We are in the early innings of a structural revaluation. This isn't just another bull run. It's a transfer of wealth from paper to tangible. And when the dust settles, history will record that gold quietly outperformed the S&P for a decade before anyone noticed. That's how every great rotation begins. Quietly, logically, then all at once. So yes, I think we're in the middle of something historic. Gold is breaking out not just in price, but in psychology. It's reclaiming its role as the center of trust in a world that's lost it. And the irony? Most people won't realize it until gold's at $5,000, silver's at $75, and the financial media starts running, "How did we miss this?" headlines. By then, the smart money will already be positioned. So let it breathe. Let it dip. Let the nervous money shake out. Because what's coming next is the vertical phase, the whoosh. The one that takes you from disbelief to mania in record time. And when that happens, remember these weeks. Remember that the world's most boring asset quietly became the most powerful chart on Earth.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.